Good evening, TheoTrade. This is Corey Rosenblumen. You're watching the Theo Nightly video for the 10th of September 2020, and the markets have returned pretty quickly to the scene of the crime. What's that? What levels are important? And what are the sectors saying about trade opportunities and what we're looking to do with our portfolios? Let's start with the scene of the crime. The market rallied a little bit higher than expected, a little bit more extended than expected, and then snapped right on back like a rubber band. Failed to hold support at 34.50, but then went all the way to the 3330 level. And this is the S&P futures. It's mainly the 50-day exponential average. You can see it a little better on the hourly chart right here. That is the 3335, the push down. We talked about on Tuesday's video, markets holding support, especially the tech stocks. And that level held, and it resulted in a bounce on Wednesday. It is Thursday now, and we are about at the same level where we had that prior video. So the same type of logic and the same type of play will hold. So if the market does hold the support level, we're back to this scene of the crime and a retest of the support and a possible bounce. But given that we are here a little sooner than expected, we can easily see how this market can break all these support levels and tranche on down, tranche lower. And that will be a scenario, this one happened a little faster, similar to February into March, or any other example where the market held support. We'll actually go back a little back in time here. I want to maximize this and go back a couple of years. So it's any number of examples where a market has hit support, came up a little bit, shattered through it. And these again are our gravity spots. Similar. Market traded up, hit that 50 exponential, had a little bounce, and then down through it. Last time we saw this again was the coronavirus crash. We've not been under the 50-day exponential average, except for one little blip, since the bottom of the market in April into May, when the market began trending higher. So that is a key spot to watch and remains the key spot to watch, and it's roughly 3340, 3330. That's in the S&P futures. In the Nasdaq, this is the tech-heavy sector, and your level to watch is about the 11,000 print. It's still the 50-day moving average. It's still the scene of the crime. So those are levels to be watching for any type of support bounce, and the probability perhaps is decreasing for additional upside action. But right now, this is a good spot to initiate trades. If you are bullish, those trades still apply, but will be stopped out or will be closed, ideally, on a failure or a break under here. If you are bearish, you had a chance here to play some short positions that took a little bit of time to see the market snap back. But the target was either the 50 or the 20 exponential, and they've been achieved. So now we're back at that same level. A failure to bounce here probably opens the market to a deeper sell-off, way lower, and we may even have to go to some of the weekly charts to see where those targets are. So keep in mind, I'm looking at the daily chart first and the weekly chart second. But the main idea is if this 11,000 fails, you'll see the market fall pretty quickly to this 20-week exponential, and that's about the 10,500 spot in the Nasdaq. In your S&P, that similar target is going to be about 3,200. If you're curious, the markets are a little bit different. Given that the Dow futures did not breach 29,000 earlier in the rally, did not make new 2020 highs, just for quick references, that's about the 26,600 level in the Dow, and the Russell is the weakest of the indices. So that is the play at the moment. In terms of our sector ETFs, we can take a look at each individually, which to save time, we'll just see them all together. Now, what we're looking at here is the sector rotation model, or just sector strength. The S&P 500, the market, is made up of about 9 to 10 sectors. We segment them by the bullish or the offensive sectors, which are here. That is financials, technology, discretionary or retail, Mid-cycle sectors are the industrials, materials, and energy. Beneath all that is the defensive names, and those are staples, healthcare, and utilities. Think of utilities especially like a bond, like TLT, or these 10-year or 30-year bonds or notes. They're just defensive. They're still stocks, but they are defensive and typically have high yields. They are considered risk off. The weakest sector on the frame is and remains energy, XLE. That's going to involve Chevron and other companies like ExxonMobil and a few others. So that is a weak market or a weak sector. In fact, the weakest sector. You can see that from the percentage. This just takes it back roughly a year in time, if not a little more. And that's your back to here. Yeah, it's a year. So each chart here shows you 1 year in time. Just a random sort of spot. You can look at these in terms of percentages. So the weakest, again, by that is 46% to the downside for energy. And the strongest, not surprisingly, it may not look like it on the scale, but it's here, technology. From last year, technology XLK is up about 40%, followed by retail. Remember, Amazon is actually a retail stock. The retail sector is up about 16, 18, almost 20%, and the rest are a little bit weaker. Healthcare is up 15, and materials is up about 12. Nevertheless, this is a divergence, or at least a split in the sector. So if you're looking to play within the market, markets do typically trend higher, but you can gain access to faster profits, or almost like betting on the faster racehorse or faster car by things moving up more than the market. This is just relative strength work. That remains technology, retail, and to an extent healthcare. And the slowest horse or the slowest car is energy. You can actually build pairs trades within these if you wish. And of course, look at individual stocks that are stronger, and that includes some of our titans of tech. Nevertheless, the market itself is rallying and has rallied, but weakness has remained in utilities, energy, and to an extent, industrials, and of course the staples. So that's the bigger picture of the market. So as we push into this week, we are at a precarious point. I like to call it, as mentioned in the video, the scene of the crime. We do not know what's going to happen. There's no way to know that, but just the volume. Just make a note of volume and let it guide decisions. Strong red or bear or distributed volume right now does tend to suggest a little bit of weakness or lower prices are likely. So we're starting to get the bear side of the market playing. And we've had bull volume go down, bear volume go up. That's something that typically happens before a breakdown. Aren't there yet, but could be very soon. So let these levels play into your decisions. Of course, watch your daily levels, and it's ultimately where we are at the moment. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video for September 10th, 2020.